If I'm right about where I think this macro stuff is headed, this melding of Treasury and Fed and into one policy of 1.5% of the short end and 3% of the long end, and that's what the yield curve is going to be. And under those circumstances, we're going to grow ourselves out of it and everything else. If I'm right about that, we're going to go to 4,400 faster than 5 years. And I can say that without having to come up with outrageous predictions about this or that. We don't even have to talk about the London float. We don't have to talk about silver and leverage, and it's just going to happen. And silver will go through 50, and then it'll probably be like gold.
CraigHemke often reminds people that gold and silver don't change. What changes is how many dollars it takes to buy them. 50 years ago, it was a fraction of today's price. 10 years ago, the price of gold was $1,100 per ounce. 5 years ago, $2,200. Now it's around $3,300. Hemke says in a few years, it'll likely take $4,400. The dollar continues to weaken, while the metals themselves remain stable. When it comes to performance, Hemke stresses that 25% annual gains in gold are rare. Since 2000, we've only seen 3 such years, one of them being last year. Expecting back-to-back 25% years would be unusual. Even a 10% gain following a strong year is impressive. That's why Hemke originally forecasted gold at around $3,100, possibly $3,200, with silver near $37. Instead, gold surged to $3,400, forcing a reset in expectations. So what fueled the rally? Hemke points to 3 factors: a weaker dollar early in the year, heavy central bank buying, and physical tightness in key markets. If the dollar stabilizes, he says gold and silver could trade sideways for a time. Looking further ahead, Hemke argues the U.S. cannot stop running trillion-dollar deficits. Politicians promise fiscal restraint, but the math never works. Even this year, with all the talk of discipline, the U.S. is still on track for a $2 trillion deficit during what are considered good economic conditions. For Hemke, this guarantees that gold will continue grinding higher. If policy holds, Treasury and Fed effectively locked into low rates, Hemke sees gold hitting $4,400 in less than 5 years. Silver would follow, breaking $50, pulling back, then climbing again. Once $50 becomes the floor, silver enters entirely new territory. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It took about $14,000 when Nixon closed the gold window 54 years ago. It took $14,000 to buy one.
He suspended it temporarily. Let's get our language correct here.
All right, I misspeak. He gets a bad rap. It was only temporary. They didn't have any choice, actually. I mean, U.S. has allegedly 8,133 metric tons only because he closed it. I mean, if he'd kept going, we'd have 0. But anyway, that's a whole other story. Anyway, it took $14,000 to buy one of these. 25 years later, it took about $120,000 to buy one of these. It now takes about $1.2 million to buy one of these, which again is not unlike what I said 10 years ago, 2015, this time of the year, it was $1,100. 5 years ago, 2020, this time of the year, it was $2,200. Now it's $3,300 to buy one. Now, the gold doesn't change. Gold stays the same. So if I'm right about where I think this macro stuff is headed, this melding of Treasury and Fed and into one policy of 1.5% of the short end and 3% of the long end, and that's what the yield curve is going to be. And under those circumstances, we're going to grow ourselves out of it and everything else. If I'm right about that, we're going to go to 4,400 faster than 5 years. And I can say that without having to come up with outrageous predictions about this or that. We don't even have to talk about the London float. We don't have to talk about silver and leverage, and it's just going to happen. And silver will go through 50, and then it'll probably be like gold. Gold broke out through new all-time highs, at the end of 2023? It then went sideways for about 3.5 months, and then it went from 2,000 to 3,500. Silver will go to 50 again, probably next year. I wouldn't say it's going to happen this year. Anyway, it'll go up there again, and then it'll fall back, and then you'll get the people that say it was a triple top, and there are no triple tops. There are double tops. There are double bottoms. Once you top 3 times in anything, 4 times, it's a trading range. So anyway, then you'll get the triple top people and all this kind of stuff because it'll go up there and it'll fall back. And then it'll go through and it'll be 50 something and everybody get all excited and go to 55 because usually things, once they break to a new all-time high, go up about 10% on the hype. And then it'll fall back and 50 will become support. I mean, this is all exactly what gold did 2 years ago. Silver will do this in 2026. And then you're just in this uncharted territory, beyond which be dragons. And again, till something completely breaks, we get into a different pricing scheme. I mean, this one's held now for 50 years. Then we have to deal with the system that we have. And under this kind of, we'll call it a fractional reserve, digital derivative pricing scheme, 25% annual gains in gold are pretty rare. And you just go back to the year 2000. I think there's been 3. One of them was last year. And so it'd be really unusual to have another 25% year on top of that. Even if you go back to 2011, right? Or 2020 was one. Just even tagging on a 10% gain after a 25 would be remarkable. And so that when I wrote I write that forecast every January, that's kind of what I was thinking. I thought, okay, we'll probably pop up to 3,000, maybe 3,100, because that would be a great year. Now we've been to 34. That's a hard thing to temper your enthusiasm after we came out of the gate so strong. But yeah, if we were just to go sideways the rest of the year, for any historical measure, that would be a fantastic year. So then you got to ask yourself, okay, so why are we up? Why is silver up so much this year? And I think a lot of that is just, we have this tremendous decline in the dollar index for the first 3 or 4 months of the year. Mm-hmm. Metals kind of took off. The dollar index, starts to go sideways as it has, or starts to recover, then we may continue to go sideways a little while longer. But in the grand scheme of things, Chris, I always like to point out to people, it's not the gold that's changing. It's not the silver that's changing. Those metals are just the same as they've always been. It's the fact that it took 1,100 Federal Reserve notes to buy an ounce 10 years ago, and it took 2,200 Federal Reserve notes to buy an ounce 5 years ago, and it takes 3,300 Federal Reserve notes to buy an ounce now. You can safely assume it's probably going to take 4,400 Federal Reserve notes a couple more years from now. So I try to keep an eye on the big picture and not get too caught up in the day trading, up and down stuff. So what's coming? Look, I think it's great that we've had this great year, and it's telling us, between the central bank demand, relative scarcity, I guess, in a sense, of physical metal in certain areas, and all the tariff stuff and all the other stuff that's happened so far this year. Now, this great year so far in gold, great year in silver. We could go sideways the rest of the year. When I wrote the thing first week of January into December, I said, well, maybe we'll get to 3,100 in gold, pull back a little bit, finish we up 10, 12%. Silver might blast. I thought it would get to 41 or 2 and then pull back and finish the year around 37. That might end up 37 might be where we end up. But it's next year that has me most intrigued. If I've gotten anything right this year, I thought gold would go higher. I didn't think it'd go this high so far this year. But coming out of the election, there's all this exuberance in this narrative that was being put forth. And the dollar was rallying. What did the dollar index get to? 110 or something like that back in January? Because Trump was going to balance the budget and Elon was going to cut all this waste and spending. It was $2 trillion of wasteful spending, and all this stuff. I was like, this is the biggest pile of crap I've ever heard, because I've heard it before and it never happens. And it's impossible to happen. I don't mean like it's not important, the things they did do, but the notion somehow that they were going to balance the budget, by eliminating wasteful spending. Shit, I was hearing that 30 friggin' years ago, right? And now we're 37 trillion in debt. Even the most recent, the Department of the Treasury puts out a statement.
You were in your 20s when they started saying that.
I remember it all. I was listening to Rush Limbaugh back in 1992, hearing about this stuff, right? And Newt Gingrich, and then they did try to run what appeared to be a balanced budget for a few years back in the late 90s, and there's just no stopping the train. It's just math. It's not complicated. But they try to talk certain narratives into existence, and that coming out of last year, that this year was going to be about fiscal austerity, and the deficit was going to get trimmed and all that. The U.S. Treasury, maybe people don't know this. The Treasury Department puts out what they call their monthly Treasury statement. That's creative. Every month. It's like the 8th business day of the month or something. It comes out. We're now 2 months away from the end of the fiscal year for the U.S. government. It ends September 30th. The new one begins October 1st. So we only got 2 months left. We've got all the reports through July. Even July, okay, we ran a $291 billion deficit in July. And you think, well, okay, that we probably did 350 billion. No, we did 240 billion last July. So this notion that somehow, they're really slowing things down, it's just crap. We're going to do a $2 trillion total deficit this year. When the fiscal year is over, it's going to be $2 trillion or so by the time it's all said and done, ahead of last year's pace. There's no stopping it. And Chris, this is all allegedly during a time of robust economic growth. We're going to grow our way out of it. Hell, Besant was out even again today saying we're going to tariff things so much that we're going to pay down the debt. And I'm like, who believes this crap? Maybe the algos, all the machines that scan the headlines and then, trade things. So anyway, if you understand that math, and I don't mean to be like this pessimistic, grumpy old man, but it just is what it is. That's why I kept buying gold and silver all through 14 and 15 and 16 and 17, right? You did too. I mean, the math is the math. And so back to my original answer about being up 2 years in a row, even within this pricing system, that's telling you something's, what's what. Maybe we're getting a little close to kind of this terminal phase of everything. And that may set us up for even more interesting months ahead.
Since the start of the year, the conversation around gold has been dominated by noise, tariffs, speculation, and dramatic claims of gold moving out of London and into U.S. vaults have filled headlines. But CraigHemke argues that behind the chatter, a much bigger development is taking shape. In February, Treasury officials floated the idea of monetizing assets. Hemke points out that realistically, the only viable asset for such a plan is gold. Around the same time, several bills appeared in Congress that proposed both the creation of a Bitcoin reserve and a revaluation of U.S. gold holdings. Here's where it gets interesting. U.S. gold is still officially priced at $42 an ounce, a figure set decades ago. If it were suddenly revalued at today's market levels, it would unlock roughly $800 billion on paper, which would be counted as deficit neutral. Hemke explains that the plan would be to funnel this windfall into purchasing approximately 200,000 bitcoins annually for 5 years. The endgame involves the quiet buildup of a government reserve comprising both gold and Bitcoin. For Hemke, this perspective also sheds light on why a significant amount of physical gold has been returning to U.S. vaults. If the government is preparing for revaluation and the issuance of new certificates, it needs the gold in its possession rather than scattered abroad. By securing the metal now, the U.S. reduces the risk of other nations catching on and attempting similar moves. Let's get back to the interview.
I've been writing about this topic since January or February. We were told, it's all about tariff concerns and all this stuff, and all this metal. Remember StoneX, the big commodity firm, said it was 2,000 metric tons? Remember that dude? I know you don't have that clip queued up. I'm not trying to put you on the spot, but it was some dude from StoneX that said it wasn't 700 or 800 metric tons. It was 2,000 metric tons plus that had left London and come back to the U.S. Yeah, this great distortion between spot and futures, all that kind of stuff. This is another thing where I think they're telling you what's coming. Okay, Besant on Sunday, February the 3rd, was standing to Trump's right in the Oval Office as Trump was signing an executive order. He said, Trump signs the executive order, and he says, and somebody says something about where are you going to get the money? He says, well, Scott's got some ideas on that. And Scott's standing there like, oh shit, I wasn't expecting to talk today. And he mumbles his way through about a 2-minute answer where he talks about the asset, monetizing the asset side of the balance sheet.
Yes.
And that kind of gets everywhere. So like 2 weeks later, somebody asked him about it on CNBC or Bloomberg. He says, no, I said, I mobilize the asset side. And no. Again, this is where the blob sitting there interviewing him could have said, no, here's the clip. You said monetize. And I remember I wrote a thing for Sprott saying, what are they going to monetize? The only assets they have to monetize is the gold. What are they going to do? Parkland? The tanks? Some office buildings? Okay. Also in this is Trump's idea of creating a Bitcoin reserve, right? Mm-hmm. There are bills in front of the U.S. House and the U.S. Senate authorizing them to do this. Besant came out last week and he said, no, we're not going to buy existing Bitcoin. We're just going to, all the ones we've confiscated and stolen, from other criminals, we're going to keep those. And they asked him about revaluing gold, which is in these bills, and where he had flat out a couple months ago said, we won't be doing this. He said, the Treasury is looking at revaluing something like that. And he said, I doubt we'll do it. Again, these subtle language differences, not monetize, mobilize, okay, whatever. In those bills, anybody, please don't take my word for it. Google Bitcoin Reserve Act or whatever, and you'll see the House version and the Senate version. And in the U.S., the House has a version, the Senate has a version. It goes through committee that gets voted on, and then it goes and gets reconciled into one bill because they're going to be different. And then it goes back to the House and back to the Senate. And if those both get voted on, then the president signs it. And the president said he wants to do it. And in the bill, the funding, as Besson said, would have to be deficit neutral. The deficit neutral funding of this is an accounting gimmick where the U.S., which currently by federal statute values their gold at $42.02, 42.222222222. That's in the federal U.S. code. Written in these bills is the process to amend that code. Demand that the Secretary of the Treasury, melding of the Fed and the Treasury, demand back from all the Federal Reserve banks all of their gold certificates. And then the Secretary of the Treasury shall reissue within 180 days new certificates for the Fed to hold based at the current market price. It's in the bill. It says that this is what they're going to do, okay? Revalue the gold at the current market price. Now, again, I don't know what that means for the gold price, other than gold is a store of value, which is what Besson said last week. It's not an antique. It's not something that, as the Ben Bernanke said, we just hold out of tradition. No, Besson said it's a store of value. So we're now going to mark it back up to what it actually is. But the gimmick, the accounting gimmick is, if you change that mark just to today's price, it's about $800 billion that the Fed suddenly has, that then they can just hand to the Treasury on a deficit neutral basis. It's $800 billion that just comes out of nowhere.
At least that won't be inflationary, right?
Well, they take that $800 billion and they buy whatever that is, 200,000 Bitcoins a year for 5 years. That's how they're going to do it. I'm not making this shit up. They're telling you where this is going to come from. So anyway, putting it back together with your initial question, why is the U.S. repatriating all this gold? Remember the talk about we're going to audit Fort Knox? Remember that back in February? And then that just poof. There might be some value to actually, if you're going to do these certificates, rather than just outright fraudulently say that we're revaluing something we don't have. Well, okay, we're repatriating our own gold from wherever ahead of everybody else, before everybody else gets whiff of this and starts a bank run. So anyway, that's how I think all this stuff connects. And again, I don't mean to be Russell Crowe and John Nash in his garage with, all these Post-it notes and strings. But I do think that if you connect the dots, you can see what's coming next year. And it's really not a whole lot different from me continuing to buy silver when it was $14 and $16 10 years ago, because I could connect the dots and I saw what the math was going to be. This is just the same kind of exercise, only in a much shorter term. And I think they're telling you that 2026 is going to be a doozy. If Powell makes it all the way to May, when the end of his term, Trump will nominate somebody or tell who he's going to nominate by the end of the year, and people will start connecting the dots. Which is kind of what happened in February with the gold price anyway. People started figuring this stuff out, which is why we had, with the dollar going down, such a big rally to start the year. So anyway, moral of the story is, I wouldn't get discouraged right now. I don't know what the price will do in the short term. Who does? I think we've got some interesting times ahead, my friend. They've also told us, the Secretary of the Treasury has told us, that we need to totally reimagine the relationship between the Fed and the Treasury. That we need kind of a different, more hand-in-glove approach if we're going to manage all this debt, right? They've told us that that's coming. So I would imagine, I mentioned yield curve control earlier. If you're going to cut this Fed funds rate to 2%, and you remember the last time when the Fed cut 50 basis points last September, remember the bond market sold off? Get kind of a buyer's strike. And the federal government can't, we're going to be $1.1 trillion in net interest expense by the time we reach the end of this fiscal year. $1.1 trillion. That's going up, even if you hold interest rates the same, just the amount of, debt that you're charging that 3% on is going higher. So if that goes to 6, now what are we, $2.2 trillion? The line item just gets out of control, right? It becomes greater than even Social Security, just simply servicing the debt. So if you're going to amalgamate, meld together Treasury and Fed, they're telling you yield curve control is coming. And people could say, well, that didn't work in Japan. Well, it worked for a while. And what do I mean by that? The Fed will say, in this new Fed Treasury model, where the Treasury has to do all the actual issuance and refunding and all that stuff, the Fed will say, come to me. We are buyers of everything above 3%, 3.5%, 4%. I don't know. It ain't going to be 6%. We are buyers of all long-term debt above 3%. And you want to talk about but this is the way it has to go. I mean, in my experience, me reading the tea leaves, they're telling you this is coming if you're willing to connect. And then be patient. That's why I get so frustrated with this, these forecasts that are like outrageous for where silver is going to be by Halloween or something. Because all that's going to do is piss people off. And when it's not whatever dollar amount by whatever date later this year, people are going to throw up their hands and, this is bullshit, blah, 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 blah.
The gold price retreats on Thursday following the release of mixed data from the United States, as traders brace for the Jackson Hole Symposium and await Federal Reserve Chair Jerome Powell's speech on Friday. Cycles of strength and pause are nothing new for precious metals, but what makes this stretch different is how policy decisions, fiscal strain, and the quiet repositioning of reserves all seem to be converging at once. Gold and silver may not move in straight lines, yet the structural forces shaping their trajectory appear far stronger than any short-term swings. The real story isn't just about prices climbing higher, but about how deeply they're becoming tied to questions of monetary credibility and national strategy. Could the steady buildup of these pressures mean the next leg higher in metals isn't just another rally, but part of a fundamental shift in how global finance values them? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.